So I just want to start by welcoming everyone and thank you for joining us. I'm Greg from Reliant Fund Services, and today I'm here with our founder and owner, Eric Schultz. So let's start at the top. We're going to talk about management company budgets today. So Eric, what do most emerging managers and general partners get wrong when building their first management company budget?
Great question, Greg. So first, I'm going to just give a little background. My background is doing over 30 years of outsourced controller, outsourced CFO in the emerging manager space and existing managers, as well as fund admin. So I've been around, and also taxes. So I've been around this industry. I've seen over 20 or 30 emerging managers, help them with their cash flow budget. So I feel like I have a unique ability to help managers or first-time managers get the budget right. Let's actually start out with what usually happens, not what should happen. And I've seen this, time and time again. We'll picture this: an emerging manager leaves a big company like Goldman to start their own fund, and one partner is suddenly tasked to handle all magic company operations. I call them the unlucky partner. They'd rather be sourcing deals, but instead they're trying to figure out payroll, rent, QuickBooks, and benefits from scratch. And benefits are a nightmare. So it's trial by fire, and they're usually Googling how to build the budget the night before their LP meeting.
Mhm.
That's why we're here. We're going to take them history out of all of it. That's why we think a well-built management company budget from day one is so important. It gives the structure to the chaos. It forces you to think through staffing, tax reserves, GP commitments, tech needs, and all the operational nuts and bolts LPs assume you've already thought of. The goal isn't to turn you into an accountant. It's to help you see what a management company budget should look like with a solid and realistic timeline, especially in the first 12 to 18 months. When they say when you treat the management company like a real business, everything else falls into line: reporting, operations, and even fundraising.
Okay, thanks, Eric. So, I guess, where do you start when building a management company budget?
I think a lot of the biggest mistakes come from when managers are blurring the line between what's a fund expense and a management company expense. And generally speaking, it's determined what's a fund expense in the LPA or the PPM. There are clear management company expenses, but there are some that are ambiguous that sometimes you actually need the lawyers to determine. But it's very important to make sure you're clear on what is a fund expense and what a management company expense is, because the SEC is watching, and also the auditors are watching. So you have to draw the line clearly. What a fund expense is generally what are called investor facing. They include the fund audit, tax prep, legal expenses, whether it's to the PPM, the sub docs, anything along those lines, any deal expenses, fund administration, and even D&O. A lot of emerging managers think they have to bear the cost of the D&O. And again, the LPA kind of dictates anything other than those items. They'll actually specify what's included as a fund expense. And the management company expense is everything else. It's payroll, manager salaries, GP salaries, compensation for the team, all their benefits, marketing, tech, rent, software, business development. Anything you will need to run that company is generally a management company expense. But you have to separate them cleanly from the beginning, or you will be overcharging some of those management company expenses to the fund, and that's not a good look for your LPs.
Okay, so now once you understand that split and it's clear between what's fund and what's management company, how do you actually start preparing the budget?
I always like to think of it as four core pillars. One is people, right? The how much are the owners going to pay themselves? How much are they going to pay their analysts and their executive assistants and their whoever they're hiring, their payroll taxes, healthcare, their bonuses. Most managers overhire in the beginning because they think about they have all this revenue coming in, and they hire a CFO or a controller because they think they need that person. But actually, it really it really they should really consider staying lean until they actually start getting to Fund 2 or Fund 3. Every dollar they spend now is a dollar away they took from something else they could spend in the future. Most, as an outsourced controller CFO, most first-time funds don't need a full-time CFO or controller. There's just not enough work for them to do, especially in the beginning of the fund. There's no deals. There's really very limited amount of work, and a fractional CFO or controller is really the smart way to go in the beginning. I actually calculated. I actually did a comparison of what it costs to have a CFO or a controller, and then someone underneath that person that would do bookkeeping and things like that. And overall, it's about a third of the cost to do it outsourced than it is to have someone full time in the office, and that's without even allocating carry points. So just think about that. You're saving, hundreds of thousands of dollars that could either go to the owner or be spent on marketing or another hire for an analyst. Another thing I actually wrote about, because I do have a lot of experience. There's something on our website that I wrote. It's called In-House CFO versus Outsourced CFO, and it really goes into the details of why having an outsourced CFO for Fund 1, maybe Fund 2, is a lot more cost effective, but also business sound, because you're getting the benefits of generally a firm that has 3 to 4 people assigned to your account, rather than one CFO that only has the experience of a CFO that he only had from his training. And also, if that CFO leaves, you really have no backup. So that's one of the reasons why a lot of people think about an outsourced CFO. The next one is professional services, outsourced fund admin, legal for the management company, compliance, tax prep, bookkeeping, any professionals that you're going to outsource to help you run the business. Overhead. So, that is, professional service, yeah, right. So the overhead is rent, utilities, anything that is going to basically help keep the lights on. I'm trying to think of any of those, but those are the really thing. And then business development, travel to LP events, CRM tools, conferences, partnerships. Basically, you're always in business development, because you just closed Fund 1 and you already have to think about Fund 2 and Fund 3.
All right. So I guess next, what about revenue forecasting? Isn't that usually where things kind of break down and get a little messy?
Yes. For as smart as the emerging managers are, they've never seen an allocation of a management fee offset over 3-year periods that is a split between 80% management company and 20% fund, right? They're just not used to that. So they're not even thinking about that. All they think about is, oh, I have 2% of commitments, and that's my money, right? But actually, you have to think about what's actually usable and not what is projected. You need to account for fee waivers in case where managers elect to waive management fees and have the LPs fund their investment on their behalf. That is a tax structure that allows the general partner to invest in the deals with tax savings. You also have placement fees on a lot of these emerging managers, and those things they are usually paid at the same time you get management fees. And so every dollar you pay a management fee, you receive a management fee, you're probably losing 30 to 40% to a placement agent, and that really bites from the gross revenue. You also have transaction fee offsets, whether you did a deal or a deal fee or a transaction fee. Most LPAs have a management fee offset in that in the agreement. And then last but not least, you have staggered closings. Not every fund, especially these days, not every fund is closing on full commitment day one. That could extend over 2 to 3 years these days, and that just kills the cash coming into the door. So you really, it's revenue isn't as simple as it looks, and that's a lot of where the managers get into trouble.
Okay. What expenses tend to like pretty much just come and creep up over time?
Yeah, so I think the biggest one is salaries, right? Because the managers are hiring these amazing analysts, all commanding, they've all gone to Harvard and business school,
Mm,
and they all want to get paid top dollar, and they're all the managers competing against bigger funds, right? So they have to pay these people top dollar, and generally speaking, these analysts expect 30 to 40% bonuses year after year with raises. So if you hire one too many analysts, you could be running out of capital by year three before you raise fund two, and therefore you now have to start laying people off, which no one likes to do. Or you have to cut salaries and bonuses, which you're almost guaranteeing your team moving to another fund. So, things like that you have to think about. Technology, I mean, especially now with cyber and everything going on, the performance tracking, your CRMs, it just, what started out at 5,000 a month for your IT is now 25,000 a month, right? And that
mhm.
just takes away from the fixed dollar revenue that the management fees are.
Okay. So you said you've been doing this for a long time. You've built a lot of, management company budgets.
Mhm.
What are some common, I guess, mistakes that you've seen through the years?
You know, you know, some of this will be a repeat of what I said before, but again, LPC 2%. Sorry, the LPA says 2%, but that's gross. It's you have to apply waivers, deal fees, offsets,
Mhm.
and placement agent costs. So it's a lot smaller once you actually offset those items. Again, hiring too early. The goal really is, as a first-time manager, is to keep your costs lean. Figure out what your actual run rate is, and stabilize, and then you can just make decisions to hire and spend the money. And again, just thinking about expenses ramping, like payroll, that I discussed before. So that's really it.
Okay. So what would you say investors really want to see in a management company budget?
Definitely sustainability. They they want to see that you could survive 12 to 18 months. If fundraising slips or it gets delayed, or there's just unexpected expenses. They definitely want transparency.
Mm,
They want to be able to see what's running through the management company's books and what's running through the fund's books, and if there's any line crossing, especially these days. ILPA, ILPA is requiring very detailed reports that will easily catch if you're allocating an expense to the fund when it should have been a management company. And also alignment. Are you paying yourself reasonably, or living like it's fund four? Are you taking 90% of the revenue as a salary, and only hiring one analyst and working from home? They don't. The LPs don't expect you to have a profit, but they do expect discipline. And I
mm,
always I always like to say, if you can't run your own business, how can they trust you to run a portfolio company?
it's true. All right. So I guess just changing it up a little, how does tax planning fit into this?
I've done tax for 30 years, and it's the worst thing ever. Everyone hates talking about taxes, paying taxes. But here's the deal: most management companies are pass-throughs. So, and generally speaking, at that level, managers can't get paid as a salary like they used to at their old firm. They're paid a draw, and draws are not subject to withholding. You can't withhold from a draw. So they're getting their gross salary paid to them monthly, semi-monthly, whatever it is. And if they're not planning for taxes, they're going to get hit at the end of the year with a 30 to 40% tax on their gross revenue. And
Mm,
so I always advise managers to put a line in the budget that's a tax distribution, so that they can pay their taxes quarterly. You definitely don't want to spend all that money, and then at the April 15th you have to come up with $100,000 because you didn't plan properly.
interesting. All right. So if somebody's doing their own management company budget, what are some best practices you would give them to keep that on track?
Yeah. Yeah, I mean, start simple. Build your own draft first, because you know where all the hidden traps are, the upcoming expenses. Um, I do have to point out, you have to hire an outsourced controller CFO or someone that has just done this. They know where you could save money, where to spend the money, who to use, and they bring a lot of expertise with them. And until your AUM justifies hiring a CFO, I really just think they should be outsourcing it. You track actuals and budget, right? Because you budgeted $5,000 for your IT, but it's 15,000 a month. If you're not looking at all of these items budget to actual, you're going to run out of cash pretty quickly. And again,
Okay.
in a tax reserve, um, at Reliant, this is something I've done for, like I said, over 20 emerging managers, probably more. And we've helped managers from fund 1 through fund 4 through 5, right? Like we take all the guesswork out of it. The best firms treat the management company like a startup. It's lean, accountable, and it can scalable. But when you partner with someone like me or any other firm who does outsource control CFO, we've seen it. You don't have to learn the hard way.
Okay. Thanks, Eric. Just one or two questions that some people sent in. Maybe I can just throw those at you and see what you think. One of them
Sure.
is, what are the key tax implications of a management company structure? For example, should you set up your management company as an LLC, an S corp, a partnership? What would you recommend for that?
That's a great question, and there's I can go into that in many answers. However, it also depends where you live, because, for example, New York City has an unincorporated business tax. So as a partnership, 4% of your income is subject to New York City tax. A lot of people don't know that, especially if you're out of state. So, generally speaking, most management companies are LLCs, because within LLC you could split revenue regardless of ownership. For example, I could own 80% of the management company's stock or the management company's LLC units, but only get 20% of the profit. So it gives you flexibility of allocating revenue differently than ownership. Where an S corp, you're basically taxed. You're allocated income based on ownership. If I own 30%, I'm getting 30% of the profit or 30% of the loss. Now, there is a way around that through officer salary, but generally speaking, it's a lot more restrictive, and therefore a lot of people don't like that structure. But S corps don't pay self-employment tax above, unless they call it a salary. So there's a lot of tax planning that could be done there, especially if you're making a lot of taxable income. So the answer is, Greg, it really depends on the situation.
They're all unique. Yeah.
You have to look at every situation and say, okay, let's not look at it today. Let's look at it 10 years from now, and where are we going to be? If we're going to have 10, 15 partners in the management company, all with different revenue splits, you have to go LLC. It's just too complex to be an S corp.
Got it. All right. One other question is, somebody asked, how they, with all these different, which is something you pointed on before, technology costs, things like that are through the roof now. If you get a lot of technology costs, data costs, how should they budget for those, and should they be a fund expense or a management company expense?
Yeah. Just like keeping the lights on, 95% of that, it's a management company expense. There are things that could be a fund expense. Now, we also have to remember there are LP-friendly LPAs, and there's GP-friendly LPAs. GP-friendly says I can run everything through the fund. The LPs are fine with that. They signed off on it. LP-friendly documents say you can't run anything through the fund, right? So almost all the operational cost is a management company expense. It's keeping the lights on. But there are some costs that you can run through the fund. For example, if you're using a Bloomberg terminal to do your quotes and things like that, some people need for their valuations. If the LPA allows for it, it's a fund expense. So it really depends, but 90% of those costs are management.
Okay. And then I guess just to wrap it up, any final thoughts or anything you want to talk about for management company budgets?
You really don't need a budgeting expert, but you do need a system. You got to get clarity on revenue, the discipline on expenses, and the right support team. LPs conversations go a lot smoother when you're not stressed about running out of money, and they don't want their managers having to deal with things that could cloud their judgment. So my final thought is, don't be the unlucky partner, but be the one that actually figures this out and hires the right person.
Well, thank you, Eric. Appreciate it. And thank you to everyone else for joining us. If you'd like a sample template or about a management company budget, or you want to talk about your specific situation, feel free to reach out to us after the session. We'd be happy to help you.
Thanks, Greg. Thanks, everyone. Thanks for coming.
Thanks, everyone.